All right, good afternoon. Welcome back here to Trader Minute. Great to have you aboard. We've had the Fed minutes and interesting reaction here to the Fed minutes and interesting commentary in those Fed minutes. And a lot of times the Fed minutes are yawn, snooze, who cares? But right now we are in a market that just doesn't have a lot to sink its teeth into. And so it's looking for things, and I think we've had about an appropriate reaction, in terms of what we would expect in terms of a reaction to the Fed, and ultimately the market's kind of back to where it was pre-Fed. Right, and it almost always is. When we have a Fed event, we will get a move one way, we'll get a move another way, and then we'll come right back to where it was before the Fed, and then it will start to move, after that, and we're in that kind of, back up to where we were in the Fed stage. Now, the Fed minutes did have something a little bit kind of different for the markets to kind of look at and to think about, but let's see if we can just pull it up. Let's just type in size of the Fed balance sheet. Here we go. Let's come into some images and let's kind of see what this looks like. Size of the Fed's balance sheet. Here we go. Well, here, this isn't showing where it is now, but you can see what happened to the Fed's balance sheet. It basically surged in 2008, 2009, 2010 with quantitative easing. The Fed's balance sheet just absolutely blew up and surged. And let's see here, maybe, yeah, here you go. This kind of shows you a little bit better of kind of what happened there as far as that surge. And the Fed over the last little bit has been trying to shrink the size of the balance sheet. And one of the concerns that people have is that if the Fed's balance sheet is too large, their ability to affect the economy going forward is minimized. So in order for the Fed to be able to, step in and stimulate and help the economy in the future, they need to get interest rates back to normal and they need to get the balance sheet back to normal. That's the argument. Okay, I don't subscribe to the argument. I think the argument is one that's kind of similar to federal debt levels, right? It's since I've been it was in first grade and had my first grade teacher go off about debt. I vividly remember it, and it's just been one of those things where it's always a concern, but there's always inflation, and so the debt that was taken out 40 years ago is essentially worthless today. And the debt being taken out today is going to be essentially worthless in 50 years in the way things are structured. And ultimately, will there be an end of the road? Yeah, there always is, right? When will that be? 50 years, 100 years, 5 years, 10,000 years? Obviously, time will tell. But, the concern here is the Fed's balance sheet. They're not going to be able to do anything because it's too large. Well, the Fed can always expand it more. And yes, every dollar expansion has a diminishing return, meaning, if it starts out this expanded, it's going to have to expand it even more next time to have the same impact. And that's very true. But it's the Fed. They don't have to balance their balance sheet. They can pretty much print money as they would like. And so, it's one of those where they're talking more about balance sheet normalization, but they talk about putting an end, at least short term, to balance sheet normalization. And I think in the Fed minutes, we saw something different than what the Fed has kind of been preaching over the last 2 weeks. Over the last 2 weeks, the Fed's kind of been on a little bit of a victory tour in terms of, hey, economy's great, grand, wonderful. Look, you can see it, stock market's going up, right? Okay, great. But it's one where you look at those minutes and you can see the Fed is nervous. They do see business conditions deteriorating. They do see some global risks out there in terms of trade talks, in terms of the U.S. government, Brexit, some of the normal, risks out there, and they don't want to be caught off guard. They don't want to be caught off guard. They don't want to be the catalyst or the straw that breaks the camel's back, essentially. And so they're backing off. Then they're back. They backed off on hiking rates. They're backing off on normalizing the balance sheet, and that has some interesting implications. And the initial reaction for the market is something that we've seen here today, which I think is a logical reaction. You're going to get the initial, oh yes, right? Fed's not going to shrink their balance sheet. That's going to be good for equities. Then, oh wait, they're not shrinking their balance sheet because they're worried about what's going to happen in the future. Sell, sell, sell. To, oh, we read a little bit further. Well, you know what? The future's uncertain. They're not convinced of one thing happening or another. Okay, this sell was overdone. We're right back to where we were, and that is kind of what we are seeing here today with this Fed reaction. I think this just has some. I think this going forward has some very interesting ramifications. I think right now we are in an environment where the Fed has won back the market. The Fed, it was for a time there, every time the Fed spoke or said something, market went down. We are now in one of those periods right now where it doesn't matter what the Fed says. They speak, it goes. They speak, things go up. And that is what the market has, with the Fed right now. And it is one of those where if the Fed is not correct about some of their economic projections and some of the policy actions, that could turn very, very quickly. But that's a potential in the future. That's nothing that's happening right now. Nothing that's happening, here in real time. And I think it's just one of those overall risks. And I think at this point, the Fed minutes, okay, great. Nothing that is going to serve as a huge difference, going forward here. I don't think we're going to be looking, let's just say the market were to sell off from here. I don't think market participants are going to look and blame the Fed. If the market rallies from here, I don't think the market's going to look and blame the Fed. I think this is going to kind of go away here today, but be in the back of market participants' mind, this idea of the balance sheet. And you know what? If the balance sheet stops shrinking, what is the Fed really saying there? In terms of what they're seeing economically going forward. And I think this argument, and I've heard it made by a few, that the market is in a 2007 time period. I think it is a very valid argument. And the time period of 2007 is one that markets never repeat themselves 100%. There's always something different that happens. But if we come in here to the market top of 2007, there was this period here where the market went and hit a new high in October. And right here, this is kind of when we had the famous Jim Cramer rant about the Fed knows nothing, that they're not easing and they don't see what's coming on with subprime, and we get this big sell. And at the time, this was monster. And I think you can compare it to what we saw in October, November, December here of this year. But then we get this kind of stabilization and rebound. And this rebound, as we're going up, we're getting into earnings season, and we get some economic data. And I'll never forget the high side of this day right here, this kind of bearish engulfing, where the market went and bumped into a new high. And we saw the economic data come out that morning, and the data was showing significant erosion. And I turned on CNBC, and they had an economist on there. And the economist is talking about, the numbers are looking weaker, but this is just going to be a blip. This is just, the numbers are going to start to improve going forward. And this weakening, this is just a temporary thing. The earnings, the economic data did not support this kind of Teflon-like run up here in the stock market, and it did. It pushed up into new highs. And you could argue, and the arguments are starting to be made out there of being a similar situation where this market is a little bit Teflon right now. It's just going. It just any kind of bad news just gonna fall right off. It's not gonna stick to it, and it does feel like it's in that type of mode here. Right now, but anyway, as far as the Fed's balance sheet and the Fed and everything going forward, for me, I don't think the Fed's going to make or break the global economy. I don't think the Fed's going to make or break the markets. I don't think the Fed is going to be more than a talking point from time to time and an excuse from time to time. But the Fed doesn't drive the global economy. Earnings, economics, those do. The Fed is a participant and a reactor. They're not normally a catalyst. Now, there have been times where that's been different, but this definitely isn't one of those times where the Fed is, a big major catalyst player, in the markets. All right. So anyway, that's that's kind of where things are, where things sit. Kind of my take here on the Fed, here today. Now the S&P is up about 5 points here today. Small caps though, they are up about 0.5%. And tech has gone negative. In fact, tech, underwent a pretty, a reversal. I'm not going to say pretty big or pretty small. It's neither. But underwent this kind of reversal this morning. And here's the XLK ETF. And you can see tech is not back to new highs on the day, even though the S&P is near its highs for the day. So tech has kind of had this, this kind of middle lag come into it here today. And what's happened is that as tech has done that, we have seen financials kind of do the opposite. They've kind of truck, right up and on higher here. I think 2650 on the XLF is going to be a very interesting level. I think below 2640 is going to see some heavy selling come into play if it does break one of those levels, and those are two levels that I'm eyeballing here as we go forward. But so far, at least so far in everything we've seen, we don't see the metrics shifting. We don't see the metrics changing. In fact, we talked yesterday about the number of stocks trading above the 7-day moving average. This is going to be one of the first metrics that changes if the bears are able to get some control. It's changed today. Yesterday was about 90%. Today it's about 82%. So, there's a small change here, but it's not a change that's bearish, right? It's not a change that we look at and go, wow, that is to the magnitude that shows that bears are taking control of something. But it does tell us that there's quite a few stocks here today in the S&P 500 that are starting to break down below their 7-day moving average. And that is, if we're going to see weakness coming forward, that is where we will start to see it, is in those initial stocks. So if we come into a chart here or a scan, these are just the stocks breaking below the 7-day moving average here today. You'll notice it's not a lot of the big names. Activision, Electronic Arts, Walgreens, Salesforce, okay, Pulte Homes, but we're not talking about the Apples of the world or the Microsofts or, the Philip Morris, the big names out there. We're talking about some of the smaller names, here within the the S&P that are showing up on this list, and a lot of them are in the REIT sector. They're in the REITs, or they have some sort of REIT exposure. So Kohl's isn't exactly a REIT, but sometimes it trades like a REIT with all the buildings that they own. And so if we come in and just kind of take a look at that sector, the IYR, the consumer, IYR, the real estate, REIT sector, this has been a sector that has been absolutely white blistering hot, pushing into brand new highs here, you'll notice, yeah, okay, fine, it's breaking below the 7-day moving average, but this isn't in a bearish fashion. This is in more of a consolidation fashion, or something like what we saw last week when it broke below the 7-day moving average. So nothing uber bearish about it, more of an indication of potential consolidation around this level. And so, we can take a look at some of the stocks that are, breaking down within the group, but they're not, we're not talking about, breakdowns that, are uber bearish here. Simon Property Group, I think you could argue, is a little bit different. This is one that has a lower high associated with it, has a MACD turning negative, breaking below the 7 and the 20-day moving average. If this sector sells off a little, we're going to see Simon Property Group come back to its 200-day moving average, and is an interesting setup. The options in this space, the spreads they're high. They're always high. IYR tends to be, one of the best ways to play it if you're playing options. But, that's what we're seeing. We're not seeing, massive breakdowns across the board, when it comes to, things. And we're not seeing the bears grab, any real control, at least so far. I think if you're looking to say, hey, you know what, I'm bullish, I'm staying bullish, and I'm going, all right, can I stay bullish here? The answer is yes, but I think there's a level here in the market that you have to be wary of, and that's just this kind of 2774 level, this reaction low. We had this reaction low, and what's interesting is that's the same reaction low that we saw overnight in both the Asian and the European sessions. And so I think that's, if you're looking short term and you're saying, you know what, when do I need to kind of maybe say, hey, you know what, bears are kind of coming in a little bit. I think that's the first level that you look at and say, hey, something different's going on here. I think, though, for major change, I think we're going to have to be talking about the market getting down towards this 2730 level. It probably bounces off of that level if and when it gets down here, but that's probably the level for some, where we start to see the metrics really shifting or changing in a dynamic way. Now, for the challenge, I've been, looking at a few things. Some of the stuff that, has been on my radar and to want to trade and want to get into hasn't materialized. Alcoa, for example, I talked about that. This is something, if it breaks 28, I want into the downside. Well, today it's not only not breaking 28, but it's breaking higher, breaking above the closing price from the last 5 days, and doing so on some volume here, right? I mean, there's some pretty good volume that has come in here, and this is coming on some talks that maybe some of the aluminum tariff type stuff isn't going to materialize the way that it has been expected. So there's definitely a news catalyst, associated there with it. But bottom line, it gives me price action that I can't get into on the put side. It sets up on the upside, and I priced it out. I've looked at it. Man, I'm not willing to step into it, and maybe if the challenge we're on a good streak and I'm a little more risk tolerant, all right, great. But where it sets, I'm gonna pass on it. I've taken a look at American Airlines here. With everything, I don't like the risk reward on the options. But, overall, we're not looking to close below 35, which is what I want to see. And AMD, not giving it here to me yet, even though I do think that, that it could very soon. It still just isn't there. And I can't manage the upside risk, right? It's something where if it starts to rally, where's the out point? There's not a good one, right? And so I can't manage that yet. And so, I'm kind of left there going, yeah, okay. Most of the stuff on the upside, I talked about Bank of America. I looked at this morning, and I just decided ahead of the Fed, I'm not going to get in, but, it does look like it wants to hit up into this upper Bollinger Band. I priced out the options if I'm right, and it gets up into the 30 area. I can make a couple $100, but my reward potential is relatively muted. And you know what, I as I mentioned yesterday, I want the trade that I get in, the next trades I get into, to have strong reward potential. And Bank of America just doesn't represent that, even though the chances of it moving higher, I think, are very, very high. Now, as I was going through my watch list, there were a couple stocks that kind of stood out. One of them is Capital One. Now, this is a stock that I am bearish on, that I have a strong bearish bias on, and one that has had a nice little rally here of late. It's been on some just regular volume, nothing too hot, nothing too cold. But you can see the Bollinger Band's contracting. You can see it up into this upper Bollinger Band here. And this would be the natural place to see some resistance, come into the stock. I priced out the options. The options aren't too bad. They're not too bad here. They're not something that, I look at and say, wow, I can't go and mess with that. The spreads are a little bit elevated, right? $1.45 here to a dollar, or $1.48 to $1.61. It was a little bit better when I was watching it earlier. But, it's doable. They're not fantastic, but they're doable, here with Capital One. But they're not to the point where I'm willing to take the risk just right up here without a really good stopping level. And I don't believe that this price action says anything about what's going to happen in the future, or any sort of resistance, or, this whole gap idea and whatnot. I think this is a company that reported earnings. The earnings suggest future slowing, but they're not a train wreck, So we've seen kind of the market push on up. We've seen Capital One come up into this kind of, this upper band area. And so I'll take a look at it in the morning. If it starts to sell off, I will go and chase after it and look to trade it. But, with where the options are, I am gonna hold off here. IBM is in a similar position. I talked about this one earlier today. Up at the upper band, starting to get a little bit of weakness coming in to it. I guess I should say weakness. I should say stall coming into it. And really with IBM, and I was chatting with my brother about this one earlier, I just want confirmation it's ready to move. I'm bullish on the stock, so if I play a downside here on it, it is going against my overall bias. But, a break of 137, I would not be surprised to see this thing come back to the 130. And I don't think the earnings were good enough to say, well, you know what, there's no way that it's not coming back to the earnings gap. And so, it's one that to sell off in an aggressive manner, it's going to need the market overall, but with some of the slipping that we're starting to see in tech overall, and, we see a small pullback, we could be looking at IBM trading back down to the 131, 130 level. But, I just don't have confirmation on the setup, right here and right yet. And that's kind of where I'm at with a lot of things. And so, I like Halliburton. I really like this kind of setup on Halliburton right here. I think Schlumberger is in this kind of little bit of a breakout mode right here. With it, you can see oil, pushing up into a little bit of a breakout mode. We talked about Oceaneering last week, OII, and it had that pierce of the upper band. I wasn't willing to get it there. I want to see it, consolidate or pull back just a little bit first. But some of these oil names are in very, very tempting, very juicy positions for a continued and further run. Some of them are a little bit, extended. But, a Valero here, to see Valero push up into the $90, $92 area would not take a whole lot. It definitely has this kind of 3-7 action in play on it, where the 3 and the 7-day moving average have crossed and are in a bullish position here. And so there's some real positives within this, within this space here of energy. and I'll be looking and pricing those out here after I jump off video. And if I jump in, the alert will go out there. But I do have to kind of temper some of that with I still think there's more reward potential on the downside, for the majority of things. But if the market's going to keep just tracking on higher, can I get some play out of a Hal? Can I get some play out of a Schlumberger? Can I get some play out of a Transocean or a Diamond Offshore? And the answer is probably yes. The answer is probably yes here, and so we'll be looking at that. It'll come down to how the options are priced here overall. But you can see the volumes here on Halliburton, very strong. Very nice volumes. Not too hot, not too cold, but yeah. All right. Thanks for hopping on. Have yourselves a great one, and we'll talk tomorrow. Take care.